Welcome, everyone, to the Information's TITV. My name is Anita Ramaswamy. I'll be your host this week, filling in for Akash Pasricha. It is Monday, November 24th. I'm thrilled to bring you today's show. First up, my colleague Theo published a great piece about Elon Musk's recent push to replace X staff with Grok. We'll explain. And we'll dig into a divisive topic, which is what continued AI adoption could mean for job security. Then we'll put Google's Gemini 3.0 model to the test against ChatGPT. One power user will come on to share their experience and talk about the broader chatbot wars. We've also got some tech earnings on deck, so we'll discuss what to know going into quarterly results for Zoom, Zscaler, and Salesforce. We'll end the show with a great piece from The Information's co-executive editor, Martin Peers. Martin and I will be talking about how Nvidia's fast-growing cash pile is being used and how the company is deploying its capital. It's a big show, so let's dive right in. Exclusive reporting from The Information this morning reveals how Elon Musk is making job cuts at X in a larger push to replace employees with xAI's Grok. You'll remember that xAI bought the social media platform back in March, and my colleague Theo Wayt wrote a story about the state of play today. He joins me now. Theo, welcome to TITV.
Thanks for having me on.
Awesome to have you here, Theo. So, what did you learn in the course of your reporting this story?
So the most immediate news is that at X, which was merged with xAI earlier this year, there's an effort underway to replace a lot of engineers and remaining human employees with Grok, which is xAI's LLM. And as part of that, there were some layoffs last month of engineers working in trust and safety. It's likely there will probably be some more in the future. And they're all kind of under this Elon mission of automating X essentially as much as possible.
Right. So I want to hear a little more about that. I mean, what do you think Elon's goal is in terms of how Grok is going to fit into X after the acquisition?
He wants it to run as much as possible. The algorithm, ad targeting, a lot of back end stuff. Like the recent layoffs were of people that worked in engineering for trust and safety. So stuff like detecting spam and government coordinated influence campaigns, that kind of thing. He basically thinks that you need as few people as possible doing that and as much AI as possible.
Got it. And how do these twin brothers that he's hired play into that broader goal?
Yeah, so the central characters in the story today are these two guys, Dima and Yevgen Siboliyev, who are basically they're twins, and they're basically a strike force that xAI kind of sent into X to put Grok into everything and to kind of spearhead Elon's mission here. They report to Elon, and they're kind of effectively the top engineers at X, even though Elon is technically, the top engineer on paper. But they're the boss at the moment.
Do we know anything else about them? Like, what is their background? What else do we know about where they came from and how they made it to X?
Yeah, they're interesting. So they grew up in Ukraine. They both attended this university in Kharkiv, Ukraine, where they studied math at the same time together. And then they moved to Silicon Valley. Dima worked for years at Apple and then briefly joined OpenAI last year before he went to X. And then Yevgen worked at Meta for many years and then joined his brother at Apple briefly, and then also came to X or xAI this year. So they're really interesting. They kind of work in tandem, and my understanding is, there are people at the office that kind of just refer to them as the twins and see them as like one unit rather than two people.
Speaking of two units or acting in concert, I mean, it seems like there are some parallels almost between what's going on at X, the social media platform, and xAI. Can you talk a little bit more about the similarities that we're seeing in terms of Elon Musk's approach and how he's choosing to run the two?
Yeah, so spiritually, there's kind of a similarity between this project at xAI called Macro Hard, which is a play on Microsoft.
Yeah.
Elon has kind of talked about a lot, MacroHard having this mission of basically building like a completely AI-run software company. And he's argued that like companies that make physical things like cars or spaceships are easier are harder to replace than companies that make software, and a lot of Microsoft's business is software. And so Elon says, you can basically just make an AI that can create all the software and run all the software and uh, displace software companies. And so the spirit of macro hard is like to do that in a lot of different industries with a lot of different software. At XAI, or sorry, at X, it's more narrow, but they both kind of are part of this theme.
One of the things I really appreciated, Theo, when I was reading your story was that you included some perspectives from people who were really close to the situation. Sounds like, employees. What are some of the concerns that you've been hearing about Grok and how Elon Musk plans to integrate it further into his companies?
Right. So when you think about XAI's mission of getting Grok to as many people as possible, like now that they've acquired X, they obviously have this huge way to essentially force it on people that use X. I mean, I don't know about you, but like I've never like chosen to interact with Grok on X, and yet I see it all the time.
Me
And
neither.
yeah, exactly. Like I'm not. I know some people, at Grok, is this true or something? I don't understand that, but um, there are ways in which it's worked into the UX on X. For example, like again, another feature I don't use, but I see it. If you're composing a post, you'll have this option to say like, do you want to generate an image to go along with the post using Grok? And there are all kinds of other versions of this where it's just kind of stuffed into the interface. And for some people at X, that has kind of been concerning because essentially people that work on X and that work on like the social media side don't have control over Grok, but Grok is generating all this stuff that shows up on X. So like famously, there was the Grok talking about Mecha Hitler thing a while ago that was frustrating for people on the X side because that was, this output that they couldn't control showing up. And there have been similar issues where Grok will generate like pornography or adult content or offensive things or copyright, copyright infringing things. And people at X just kind of have no control over that, even though it does impact, the product that they spend all day working on.
I mean, it sounds like it's fair to say that there are more than a few snags at this point, but I guess just zooming out, Musk's goal is to make the company more efficient. I mean, how are you thinking through the possibility of further layoffs, whether they're at his companies or even beyond, just as AI becomes more and more prevalent in the workplace?
Yeah, I mean, something that's true of XAI just as much as it's true of other, big tech companies is that, companies that have been pouring money into AI have to show some kind of result. And right now, like that can mean layoffs. I mean, Amazon, did big layoffs too. Other companies have done large layoffs after pouring a lot of money into AI. And, I think that sometimes AI can kind of be a pretense to do something companies wanted to do anyway. It's not like, an Elon Musk led company doing layoffs is, completely new. Like that happened when he bought Twitter originally. Um, but to me, like X is a pretty interesting case because these changes become evident so quickly in the product. Like, just think how often you see, new features pop up or your For You feed evolve or spam, get more prevalent and then disappear. Like there are all these changes like that as a user just become evident so much quicker than they do at other companies. So I think like, watching X and XAI will be a pretty interesting, like, front, kind of a way to see like what could be coming at other companies in the next few years.
Ultimately, do you think that that vision will work out for Musk when it comes to making the company more efficient using AI?
I mean, it's tempting to say no because there are all these potential problems, but like, think how many people said they were gonna, quit Twitter initially and are still on there. Like, it's a very persistent platform with a huge base of users, and like, I think it's possible he could change a lot more and people would still stick around.
That's a really good point, Theo. It was great having you on the show, and I guess only time will tell whether we're going to see more layoffs coming from Musk companies and beyond. But really appreciate you joining us today.
Thanks, Anita.
So it's not just at Elon Musk's companies that workers are keeping the threat of layoffs top of mind. And that's why I want to bring in two guests to talk about the reality of what AI could actually mean for the job market. Joining me next is Gil Luria, Head of Technology Equity Research at D.A. Davidson, and Andrew McAfee, who's Principal Research Scientist at MIT's Sloan School of Management, as well as co-founder of AI startup WorkHelix. Gil and Andrew, thanks so much for joining us today.
Thanks for having us.
So I want to start by setting the scene here a little bit. US-based employers announced over 150,000 job cuts in October. That was up 175% from the year prior. That's according to a report from Challenger, Gray, and Christmas. And it's coming at a time when companies are starting to more widely adopt AI. We saw Amazon laid off about 14,000 employees back in October, and the company memo that went along with that announcement specifically singled out AI. I mean, Gil, let's start with you. How much of this is truly AI driven versus a convenient narrative to cut costs?
Well, it's both, but to be clear, when we say that a lot of the job losses have to do with AI, a lot of what we're talking about right now is that Amazon, Microsoft, Google, Meta, and others have to pay for AI somehow. And so they're cutting costs in order to keep margins in spite of these massive investments in AI. So in financial terms, we're moving costs from SG&A into COGS. We're moving costs from headcount to compute costs. And that's definitely happening. How many of those people are actually being replaced by AI? That's a whole other question. The framework we're still seeing this is the framework proposed by economist Richard Baldwin that said that we're not going to be replaced by AI. We're going to be replaced by people who use AI better than we do.
Andrew, I want to pose the same question to you. I mean, what have you been seeing in terms of whether this is really AI replacing labor or if it's just an excuse to cut costs?
There are a couple things going on. One important thing to keep in mind is that outside the hyperscalers that Gil was talking about, at most large enterprises, AI use is still in its infancy. There are a couple hotspots in the organization, software engineering being the most obvious one, but it is really early in the history of deep AI adoption for organizations. So I don't think in a lot of cases their layoffs are because they've automated a ton of work away. The other thing to keep in mind is that the research is not pointing in one direction on this, but there's really intriguing research done by a team, including my co-founder and colleague, Eric Brynjolfsson, that found out that in particular for knowledge work, white-collar jobs, and for the youngest entrants to the workforce, the youngest people, the newest entrants to the workforce, that's where we're seeing employment declines compared to the past. So we could be starting to see AI's impact showing up in hiring of highly exposed professions and new entrants to the workforce.
I'm glad you brought up highly exposed professions because I wanted to ask you what you think those are.
Yeah, we don't have to rely on me. My other co-founder, Daniel Rock, who's a professor at Wharton and a team at OpenAI, wrote a beautiful paper they published in Science a couple of years ago, where they essentially looked at every task done in the economy, asked, can this be substantially accelerated with AI with no loss in quality, and then rolled that up to the job, the industry, the whatever. And sure enough, you find that a lot of white-collar work is highly exposed to AI, a modern AI, and in particular, some kinds of jobs that were not as exposed to previous waves of technology. So again, software engineering is a great example here. Up until very recently, software was lousy at writing software. And just in the era of generative AI, that situation's been turned on its head. So we're seeing these disruptions. We're seeing real innovation here. That's not the same thing as seeing massive technological unemployment in the statistics right now, because we're not.
I guess on the flip side, Andrew, I'm wondering if there are any roles that you are seeing that you think will become more valuable as AI takes root.
I think jobs that require real interpersonal skills, motivation, coordination, persuasion, those kinds of jobs become more important. AI is still a lousy, softball coach or middle school teacher or a good upper level manager. So I think caring professions and professions that require actual deep social interaction and social knowledge, those are likely to become more valuable.
Gil, I want to turn it to you and ask what you're noticing from the investor perspective. I mean, are we seeing investors generally rewarding companies that say they're replacing labor with AI and automation for their cost cutting, or is Wall Street more focused on AI actually driving revenue growth and top line growth?
Both are happening for sure. Investors always want their companies to have lower expenses. And in fact, they're starting to build that into expectations. And the way this is going to play out, it will be first at technology companies. Remember, technology companies mostly employ software programmers. So they're going to be the first ones to start seeing leverage on those programmers. They'll be able to produce more with the same number of people. So there's a lot of excitement around that. But again, the research Andrew and his colleagues at MIT have done says on the revenue side, it's also going to take a lot longer because these tools are still not necessarily ready for prime time. The IT technology stack is mostly based on structured data and deterministic outcomes with a lot of data governance. Those are three things that are very hard for AI to do right now. So it's going to take time before the tools get so good that we're generating new revenue.
Do you have any examples, Gil, of companies that have effectively used AI to either cut costs or grow their top line that have been rewarded in the market recently?
Yeah, absolutely. I mean, if you look at Palantir, Palantir has been able to help many of its clients do that. But it's really early stages, and it's really only Palantir's clients that have been able to do that. So Palantir comes in and it tells you, look, if you have this mission critical need, instead of hiring up to do that, we'll do it for you. We'll get you that result. You'll have less costs, and you'll get an increase to revenue. But so far, it's really just a handful of clients that can afford the tens of millions of dollars that they're paying Palantir. There's not a lot that's going on beyond that.
Just zooming out a little bit, big picture, even outside of tech. I mean, Andrew, I want to direct this one to you. In the past, we've seen increased labor productivity lead to wage growth. Do you think this is going to be the case with AI and that workers will actually get to share a piece of the gains? Or do you envision companies capturing most of the value here?
Yeah, you and Anita, you bring up this really fundamental fact that we've had previous extraordinarily powerful technologies. They've changed the economy, and they have not led to immiseration, to massive technological unemployment or wage declines. There are more workers, they become more affluent, there are differences based on education levels and things like that. But the story about technological innovation is also a story about increased prosperity for people. I expect that to continue even with something as crazy and powerful as AI. But you bring up this other important phenomenon that it looks like when we divide up the pie between capital and labor, historically, that division has been pretty consistent, and there's evidence that in recent years, it's been shifting more toward capital. That might continue with AI. It's a thing we've got to keep our eyes on.
So to wrap this up, I wanted to ask both of you, I mean, do you expect AI to slow down hiring in tech, or do you think we're going to see a rebound as companies sort of figure out how to use this technology and incorporate it in their day-to-day workflows?
I think it'll be a change of mix. To Andrew's point, I think we're going to have, it's going to be more challenging. If your job was to read a lot of material and summarize it, or to write drafts for somebody else to edit, it's going to be a lot harder to get a job. If you're very good at using AI tools in order to accomplish those types of tasks, you're going to have a very easy time getting a task. So to Andrew's point, then it's much more likely that we're going to have increased productivity and usage than we're going to have mass unemployment from this. But it will push the boundaries. And it's a very important point that he made about the blurring of lines between capital and labor, in that what we're talking about now is that labor will be AI generated. That's the first time where we're really talking about replacing the tasks and the performance of computing and of thoughtful and generational tasks from labor, from humans to compute. That's going to challenge the economy. But in terms of employment, it goes back to the original point I made. It's going to be people that know how to use AI that are going to do really well.
And so you don't think there's necessarily going to be a surge in hiring, a year or two from now once AI really takes root in the enterprise, Gil?
I think the labor market should be able to balance out as long as there's not exponential gains in AI. There is a scenario here. If you believe Mr. Zuckerberg and Mr. Musk and Mr. Altman, we could get to a point where there's an exponential improvement in AI where it becomes self-recursive and we get to a point where AI can do anything any human can do at least as well as a human, then we're going to be challenged in the workforce. But that's still a small probability. The more likely scenario is that AI is going to continue to drive productivity, will stay at full employment, and those increases to productivity will accrue to both shareholders of companies as well as to the labor force, because as we get good at AI, we're going to be more productive, we'll produce more value, we'll be able to get higher wages based on that.
Well, I certainly hope you're right about that, Gil. Thank you so much, both of you, for joining me on the show today. It was great to have you here.
Thanks for having us.
So we are in a moment today where the AI landscape is shifting really fast, and even insiders are feeling the pressure. Last week, The Information reported that OpenAI CEO Sam Altman sent a memo to employees warning of rough vibes ahead. That warning came ahead of Google's rollout of its Gemini 3 model, which sparked debate over whether the search giant is actually closing the gap with OpenAI when it comes to its models. So today we're bringing on Zack Lloyd. Zack is the founder and CEO of Warp, a platform for software developers using AI. Earlier in his career, Zack was actually the principal engineer for Google Docs, and recently he spent a bunch of time using this Gemini 3.0 model. Zack joins me now to tell us how good the model really is and what kind of threat it could pose to others. Zack, great to have you.
Hey, Anita. Great to be here. Thanks for having me on.
Zack, I know this is a bit of a loaded question, but Gemini versus GPT, which do you like better?
So my company is in the AI coding space, so I can speak mainly to that. We measure the performance of all of these models as they come out. And as of today, we are at the top of the benchmarks, at least one of the main benchmarks. Warp is called Terminal Bench, and we're there using primarily Gemini. So I do think Google had a real advance last week. Gemini 3 is a far superior model to Gemini 2.5 Pro, and it's certainly at least comparable, if not maybe a little bit ahead of the pack right now when it comes to using models for agentic development, which is a very important space, obviously.
So you'd say it's better than any of the OpenAI models in that regard?
At the moment, if you really press me, I think I'm just based off the data here. And so we're going off what we measure. Our best result on any evals right now has been with Gemini 3. That said, if you look at actual usage within our product, there's probably still more usage for GPT over Gemini. And then, historically, actually, the leading models in the coding space have been from Anthropic. So they've been the Claude models. And so at the moment, it's a really interesting situation. I think we have 3 very, very capable models from Google, OpenAI, and Anthropic, all pretty much sitting at not that different of a spot when it comes to coding capabilities. And what's new is that Google has really made up a bunch of ground.
And would you say that that's specifically in terms of agentic coding? I mean, are there any other sort of workflows that you found that that Gemini 3.0 is working better than other models?
So I would say across like all sorts of development tasks. So even going beyond coding. So you can have Gemini doing DevOps tasks. You can have it investigating why your servers are crashing. It's super capable. It's really capable. And we've measured this when it comes to doing sort of like long horizon tasks. And this is one of the ways that these models are improving over time is like you need sort of less and less hands-on keys, human guidance of them. And Gemini is a very good example of this where it can run for longer and longer time frames. Outside of the coding domain, I don't really feel personally qualified to comment. I watch the news like everyone else. I do think that if there are areas where I see them spiking, it is more in sort of image generation, image recognition. They have a new model, Nano Banana, which is really good. So I do think, to me, the headline is like Google is really in the game right now, whereas before it was a little bit more of a two-man show.
Yeah. Is that something that surprises you? Because at least to me, it seems like all this chatter about Google has been pretty recent.
I mean, honestly, it shouldn't be surprising if you look back at the sort of history of LLMs, a lot of the technology originated at Google from Google engineers. Obviously, the original Transformer paper was from Google. A lot of the original talent, that seeded places like OpenAI and Anthropic was Google talent. And Google just is in such a strong position commercially here that they should be able to execute on this, right? They have incredible amounts of data. They have incredible infrastructure. They are, I think it's overlooked often, but they're one of Nvidia's only competitors when it comes to actually making, AI chips. And they have huge amounts of money. So they have everything you need to be really successful. It's to me, it's not surprising at all that they have like managed to ship something that is state of the art here.
You mentioned that Google makes its own chips. I mean, another piece of the AI stack that it's touching is that it is a cloud provider. And I wanted
Yes.
to ask you how important you think it is for a model maker to actually be a cloud provider. I mean, does that matter?
I think there's an advantage at scale to having the cloud as well. So I think if you look at like the the sort of value chain in the AI space, you have Nvidia doing quite well. Then you have on top of that, you have whoever is like basically running the data centers and serving the models or doing the training. That's like they take margin. Then there's model providers who take margin. Then there's application layer. And if you can have an integrated version of that, I think you have more control over where you capture value, and you have more of an opportunity to optimize by having a fully integrated solution. So I don't know. I'm ex Google. I know Google executes really well. I think that they have all of the ingredients for being like, if not sort of dominant here, at least a major player. They have one big problem, in my opinion, which is they have this major innovator's dilemma situation, which is, I think, what has opened the door for ChatGPT specifically to really gain a lot of market share. Is like, I think Google is very cognizant of how do you roll out these AI models without cannibalizing their existing search business. So I think that's like they have this big structural business challenge, but in terms of like being really well positioned to compete, they're very strong.
And do you think Gemini 3.0 and its early success has come as sort of despite that innovator's dilemma?
It's I'm just speaking to the quality of the model. I think the big question is what do they do with it distribution wise? How do they roll it into their search properties? How do they roll it out across their apps? So from Warp's position, we use it via an API. We use it through their cloud. It's just like, it's unambiguously a great thing for us to have Google ship a great coding model that's competitive with OpenAI's and Anthropic's. It drives prices down for anyone who's building a coding app, so like us or Cursor. It it creates options for our users so that our users have choice about which model is going to suit their workflow best. When it comes to how Google is going to integrate it across the rest of their properties, I'm super curious to see. I don't know. I think it's only in their interest to obviously have better model technology, but like, how they'll integrate that in search, I have no idea.
Obviously, Zach, there's two pieces to this. There's the, the model quality piece, and there's also the business model itself. So I want to kind of press you here a little bit. I mean, let's fast forward to 3 years from now, right? Of all the frontier models out there, all the companies that are making them, you have OpenAI, Anthropic, Google, I guess Alibaba is in there too. Who do you think will be the leading player?
Yeah, so I think, again, hard for me to say 3 years out. I think what we want and what I think will happen is that you will have a competitive environment on the model side. I think everyone who's making one of these frontier models is going to want to have some killer app that's attached to it. I think it's going to be actually very hard to just be in the model API business as a sole business, meaning like, I think ChatGPT is a great example. It's like OpenAI started off in the API business, but they found a killer consumer app. Gemini, Google is going to obviously put it into all of its, they're going to find some way to put it into its search and its other properties. Anthropic is the one where I think that like they are moving as fast as they can to find enterprise applications where their models, have an edge. So they're really competing in coding. They'll probably compete in other verticals. I don't know who will win. What I do know is it's going to take a ton of capital, and you can see this with all of the data center building and capital raising. So I think it's not going to be like hundreds of companies. It will be some cohort of that group. I don't see a dynamic right now where someone like wins it. The only situation in which some company wins it is kind of what your prior guest was saying, where there's some exponential feedback loop that someone uncovers where that causes the models to be able to self-improve recursively. I don't think we've seen that yet. That's still more in like the realm of theory than reality. So I don't know, but my hope is that there's a competitive marketplace at the frontier, and then right behind the frontier, there's a set of great open source or open weight models that actually drastically drive the cost down for people who are building applications.
One thing you mentioned, Zach, was the capital intensity of this sector. And it brought me back to earlier this year when there was a lot of chatter about DeepSeek. What happened to DeepSeek in this whole conversation? I mean, how are they going to stack up in a couple of years from now?
So DeepSeek is still there. DeepSeek is still improving. I think what was so shocking about the DeepSeek kind of moment, if you want to call it that, was like, I don't think people realized that models coming out of China, and especially models that were open, were quite at frontier level. If I look at it right now, my sense is that DeepSeek is like one step behind. It's like not at the same level if you look at the flagship models like GPT-5, Sonnet 4.5, or Gemini 3. Can they catch up? I don't know. I think there's been there's a lot of restrictions on the sort of technology that you can get to build AI in China. However, my understanding, and I'm not the most qualified person in the world on this, my understanding is like that people find a way when there's such economic value in building something like a foundation model, and there's such strategic value, especially geopolitically. So I think we will continue to see models like DeepSeek. There's Kimi, there's Quen, there's other models that are just like kind of one step behind. Will they be able to get to true parity or even surpass? I'm a little bit skeptical of that, but we'll see.
Well, the chatbot wars are always interesting. So it was great to hear your perspective on that, Zach. Thanks for joining us.
Thank you so much for having me. This is awesome.
AI is starting to separate the winners and losers in enterprise software. That has led to more deal making, like we saw Adobe buying marketing software firm SEMrush last week. And it's also raised questions about what will happen to the companies that get left behind. We're in the final stretch of software earnings season here. So here to get us up to speed on the current state of play is Jackson Ader, software equity analyst at KeyBanc Capital Markets.
Hey, Anita. Happy to be here.
Jackson, welcome back to the show.
Thank you. Thank you very much. Happy to be here.
Good to see you. So let's start with a look ahead to next week specifically. We have a number of software companies that are set to report earnings today and tomorrow. And we're starting with Zoom after the bell today. What is the most important thing from Zoom that you're going to be keeping an eye out for?
I think there are probably two things. One is how is gross retention and net retention holding up? And then the other thing is if we get any kind of breadcrumbs or initial outlook for 2026 growth. Those are kind of the two things that we're looking for Zoom tonight.
How has Zoom's retention been trending in the last year or so?
It's been, I think, steady. And it really depends on which segment you're looking at. Now, remember, Zoom, we are using Zoom right now. A lot of businesses or enterprises use Zoom as their primary video platform, and that's been pretty durable. But call it the consumer use case, their nomenclature that the company uses, it's called online. The online retention rate, in 2020 and 2021, you had your, book clubs might have had a Zoom license, or, Cub Scout troops might have had a Zoom license that in 2025, they just simply do not need because they're back to meeting in person. So the gross retention rate for that cohort really suffered in 22 and 23 and 24. It has also stabilized. But the the gross retention that we really care about is more in the enterprise, and that's been pretty stable and actually improved.
How fast or how slow is Zoom growing these days, and how does AI play into that story?
Zoom, low single digits. I think we have 3%, maybe 3.5% looking out into 2026. So call it, I don't know, CPS or CPI plus or minus, a percent or so plus or minus. And AI is interesting because there are a few ways that Zoom can play in the AI space and actually generate AI revenue. One is just right there in the Zoom application where you can record things and have transcripts be summarized for kind of automatically given maybe a sentiment score by an AI agent from Zoom. And then they also have a contact center business and a phone business where AI agents can handle some of the incoming contact center requests or some of the issues that might come in. And so they can actually charge money for artificial intelligence revenue to maybe offset some potential pending headwinds on a seat count basis, where maybe in 2024, you needed 100 people to be answering phones for you. And in 2026 or 2027, you don't need 100. But they can supplement some of that potential loss in revenue by selling AI agents.
That's really interesting, Jackson. I mean, is Zoom actually seeing traction in that line of business so far?
They are. I don't know exactly, how much of their total revenue is going to be generated from AI agents at this point in the next 2 or 3 years. We cover a number of companies in this kind of contact center and communication space. It is still early, whether it's Zoom or Five9 or Twilio. I mean, there are some AI, there are real AI revenue being generated and attributed, but it's just still, I think, a little early to be able to look out the next 2 or 3 years and say, oh, this came from AI or this will come from AI and this did not.
Yeah, no, that's totally fair. I mean, I guess expanding our Zoom to broader software earnings, we have a few other companies. We have Zscaler and Workday that are also reporting tomorrow. And I noticed that both of them have been growing quite a bit faster than Zoom. And I was wondering what's behind that. Is it AI or is it something else?
Oh, I mean, I certainly follow Zscaler and Workday. I don't cover them formally, but I would say it's not just AI. I mean, Zscaler and Workday are, I would say, more in their kind of secular growth phases, particularly Zscaler from a security perspective, and Workday being a kind of a classic SaaS company. SaaS companies are still generally growing in the double digits, and Workday has the ability to drive increased sales from their channel, cross-sell HR revenue with financials revenue, or I could say HR software with financial software to generate additional revenue. Whereas Zoom just had this massive pull forward of spend in 2021 and 2020 and 2021 that they are still kind of working through at this point.
I mean, speaking of software companies that are a little bit behind in terms of growth and how they stack up with the rest of the cohort, another one I think a lot of investors are going to be looking at that I've been watching closely is Salesforce. They've made this big AI push recently. They've been talking a lot about AI agents, and they're set to report after Thanksgiving. What are you going to be focused on, Jackson, when Salesforce comes out with their earnings next week?
Yeah, it'll be the first time that we've heard from the company since their Dreamforce event and since they hosted a financial event, an analyst day. What I'm focused on are, I would say, 2 areas. One is, okay, the company expects their net new AOV to be able to grow faster than their, and AOV is kind of average order volume or annual recurring revenue. Just think of it as the current run rate of the business. So their net new ARR is expected to grow faster than the existing ARR. Just by math, that means that the company should accelerate their revenue growth. They expect this crossover to be happening kind of now and at the end of their fiscal 2026, which is calendar 2025, and hoping that that can lead to overall revenue acceleration by the time we exit, maybe this time next year. So what we want to hear is, how's progress on that goal? Are you still growing net new ARR or net new average order volume faster than your existing base? And if that is the case, then they're still on track to be able to re-accelerate growth. The other thing that we're looking for, those core clouds, so Sales Cloud and Service Cloud and even Marketing Cloud, how are they holding up? And are they going to be able to maintain their high single-digit growth rate for the next few quarters until this AI play in Agentforce and Data Cloud are maybe able to take over kind of the engine of growth when we get into next year?
Got it. I mean, it is still sort of early in this game, Jackson, but I was wondering if you had a view on which legacy software companies have done a good job bringing AI products to their users and maybe which ones haven't done quite as well with that.
Legacy software. I mean,
The companies that you cover, like in the public market.
yeah. I mean, I'm just thinking. I think you probably have to list Microsoft first, don't you? I mean, they're early. I mean, they were early in. If we think about, okay, the Chat GPT moment was what, 3 years ago, almost to the day, right? November of 2022. And Copilot, Microsoft Copilot, that was launched and announced the following spring and summer. And so while, there's been a lot of back and forth and consternation about $30 per user per month and how valuable is it, and are enterprises adopting it, I still think that Microsoft, through its incredible distribution into basically every single major company that exists, they have been able to sell and cross-sell Copilot and put really, really valuable AI features into their existing license base. So I think they're probably, they have to be number one in terms of companies that are actually monetizing AI in their applications.
And what about ones that maybe haven't done as well, or you think will still continue to struggle and have challenges catching up in this race?
I mean, we just talked about it. Even though we are believers in Agentforce in the long term, I think that, again, the things that Microsoft really has been able to drive through its sheer distribution, being able to cross-sell into its base. We think that Salesforce also should be able to do that with Agentforce, but in our initial conversations, it's just slow going. There's a lot of data cleanup that needs to be done. There's a lot of change management that needs to be done. And also, I think, there's some product innovation that also needs to happen outside of the kind of initial most obvious use cases, which are, like we said, service oriented or contact center oriented, and then business development reps, which is, hey, can you go out and maybe source a few hundred leads for me, Mr. or Mrs. AI agent, and do an acceptable, better than just a passable or acceptable job, actually show that can generate real returns for their customers. So yeah, it's been slow going, and I think that's probably reflected in the share price for Salesforce. And then the other one is probably Adobe. Adobe is just in a very difficult spot. They are competing on the merits of their model, like for like, against some of the most well-funded and well-resourced AI companies, whether it's OpenAI or Gemini or others. And that's just a really difficult place to be in if you're Adobe, because they have this fantastic creative cloud business and editing tools in their creative cloud, but people are interested in trying to come after that near monopoly and disrupt it.
Well, I guess we'll have to wait and see till after Thanksgiving how Salesforce fares. And I think it'll be a bit of a bellwether for the rest of the sector. So thank you so much, Jackson, for coming on again and talking to me about software.
Thanks, Anita.
Nvidia's latest earnings report, along with a wave of newly negotiated multi-billion-dollar AI deals, has put a fresh spotlight on the company's massive cash pile. The Information's co-executive editor, Martin Peers, wrote a sharp piece on how Nvidia has actually been using that cash. He joins me now.
Hey, Anita.
Hi, Martin. Good to have you on.
Yep.
Martin, let's start by talking. I want to hear a little bit about the pace of NVIDIA's free cash flow growth, if you can just put that in perspective for me.
Sure. So in the 4 years between 2020 and 2023, they're NVIDIA's fiscal years, which end in January of each year. So it's really 2019 through 2022. NVIDIA did a total of $20 billion in free cash flow. Last year, in the year ending January of this year, that grows to 60. And in this fiscal year, that will grow to 96 and a half. And analysts are estimating that over the next 4 years, NVIDIA could do as much as 850 billion in free cash flow. Now, I think that number is obviously very speculative because we don't have any idea how the business will evolve, but clearly their cash generation has just completely exploded.
How does that stack up, Martin, compared to other tech companies? I know you took a look at some of the other big tech giants and other inflection points in their history.
Sure. Well, I couldn't find another example. And of course, we don't have records going back that far. But I looked at companies going back about 30 years of the big companies, and I couldn't find another example where companies had grown that fast. In terms of the big companies, Google, for instance, last year did free cash flow of 73. This year, that's expected to drop to 65. Meta is, I think, this year expected to do 41. Next year, that's expected to decline to 25. I mean, what you have to remember is that the bigger companies are their free cash flow is declining because they're spending a huge amount of money on NVIDIA's GPUs. So there's this transfer of wealth from Google, Meta, Microsoft, Amazon to NVIDIA.
And just to be clear, you're saying going back 30 years, you couldn't find any examples of any other big tech companies or companies in the sector growing their free cash flow as quickly?
As quickly, that's right.
Got it. I mean, I think there's been a lot of discussion about and a lot of headlines about NVIDIA making these multi-billion-dollar investments and commitments to invest in different companies in the sector. How did Jensen Huang, the CEO, talk about that on NVIDIA's earnings call?
Well, I mean, last week he was asked about this. He was asked about the amount of money he's expected to, or that the company is expected to make going forward. And his answer was, and he was asked, "How are you planning to spend it?" Part of the answer is buying back stock. They've started to ramp that up, but his main focus is on using the cash to grow the business. So that's, I think, the reason why he's been doing all these investments in companies like Anthropic and OpenAI, or at least he's announcing those. Most of those haven't actually been done yet. They've just been announced, and they have to sort of work out the details. But this is what is driving it. He sees competition coming from Google and other companies, and he's trying to forestall that by investing in companies to give them the money to buy his products. And that's a contrast to other companies like Google or Meta, which have for years thrown off an enormous amount of money, but they have used that money to diversify. Google, most obviously, has used the money that their advertising business has created. They've used that to diversify into the cloud and into cars and things like that. So NVIDIA is using the money it has to double down and to reinforce its existing business.
It sounds, Martin, from what you're saying, that NVIDIA is in a position of relative strength, but at the same time, there's been a lot of controversy over these AI financing deals that NVIDIA has been behind and how they're somewhat circular, and that they might signal that NVIDIA is actually just trying to increase demand and trying to stimulate demand. What's your view? Is that what you think Jensen Huang is doing?
I mean, I think it's complicated. If you look at the amount of demand that he has, the idea that these investments are there to sort of prop up the business is a little, I think, misses the point. He's not creating that much demand. I think what he's doing is using the cash he has to sort of fight back competition. So, I mean, a really good example is we all know that Google is out there with its TPUs. Amazon has its own Trainium chips. And when Nvidia announced this investment in Anthropic, that was meant to get that company to buy Nvidia chips. Until now, Anthropic has been buying chips from Google. Well, actually, sorry, it's been using chips from Google and from Amazon. And so this is a way that Nvidia is using the money that it has to kind of fight back against the competition.
Well, considering the size of their balance sheet, I would not be surprised to hear another couple deal announcements, maybe this week or maybe after Thanksgiving.
Yeah.
Either way, we'll have to watch. Thank you so much for coming on the show today, Martin.
Okay. Thank you.
Well, that just does it for today's show. And as a reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We appreciate your viewership. I'm really excited to see you all tomorrow. Have a great rest of your Monday, and goodbye for now.